Good day, ECO231 students. Welcome back to week 7, term 4. This week we are going to introduce chapter 7, the cost of production. Please note that sections 7.1 and 7.2 are for self-study as it is first year work. So the narration will continue with sections 7.3, 7.4 and 7.5. Also note that section 7.6 and 7.7 is not prescribed for second year. Now, if you reflect on chapter 6 that we completed in week 6 term 3, you were introduced to production and you saw how you can take inputs such as your labor and capital, which are your factors of production, and it can be transformed into outputs. Now, the production technology, along with the prices of those factors of production, for instance, like the price of labor is wages, that can help us determine the firm's cost of production. So, in chapter 7, in particular, section 7.3 onwards, we will see how labor and capital is chosen in such a way that the firm can minimize its costs. Now, very briefly, section 7.1 explains how cost is defined and measured. So, from first year ECO 151, you are well aware of concepts such as opportunity cost, accounting cost, economic cost, your fixed and variable cost. You add marginal and average costs and total costs. So, please revise these concepts on your own time as it is for self study. And then section 7.2, which you'll find on slide 12, that delves into the cost in the short run, which you also dealt with in first year. And that is where in the short run, you have capital, which is fixed. So the cost of capital associated with that is fixed. So please revise the section as well before you move on to section 7.3, and that is where I'm going to continue with the narration. That is on slide 17. So I'm going to pause and skip over to section 7.3 now. We now turn our attention to the cost in the long run. So, section 7.3 deals with this. Now, in the long run, you know that a firm can vary all its inputs, including capital. So we are going to see how the cost of using capital and labor now factors into that production decision, bearing in mind that in the long run, both labor and capital can now be varied. So let's begin with the decision on capital and how that is factored into the production decision. Let's use an example. So, say for instance, you wanted to start a printing company. How would you go about obtaining the capital equipment you need? So, you would need to buy large printing machines and possibly obtain office space. So, you could either purchase it and spend that large financial outlay of cash purchasing the capital equipment in the form of printing machines and the office space, or you could rent it, for instance. Now, if you were to purchase the building and the printing machines, how would you try to reflect it in terms of your annual costs and your revenues? In particular, how would you reflect that as an annual cost if you have one huge financial outlay of cash in the beginning? Now, a good way to do this is to try to spread that large sum or that cost over the lifetime of your asset. Say the printing machines, so spread the cost of those printing machines over the lifetime of you having those printing machines. So you could then view the cost over an annual basis. And this is what is called the annual economic depreciation. But now, another aspect to factor in if you were to purchase the printing machines, for instance, is that financial outlay of cash used to purchase the capital equipment. If you hadn't purchased it, you could have, say, invested it and obtained some return on that investment. Interest could have been earned. So, that is where an economist would think about the opportunity cost that that interest represents that is now not earned. So there's an opportunity cost in the form of interest that could have been earned that you must account for, and you need to account for the annual economic depreciation of also having purchased those capital equipment. So now putting these two things together gives you the cost of you using the capital. So that is what we refer to as the user cost of capital. And it can be formally defined as the annual cost of owning and using a capital asset, and it is equal to the economic depreciation plus the interest that is foregone. Let's use some numbers to try to understand. So let's say you spend 200,000 on the printers, and that is the capital equipment that you require. And each year, the printers depreciates by 10,000 Rand. So if you think of the 10,000 Rand over a period of 20 years, that is the lifespan of the printers. Plus, you could have earned 10% on investing that 200,000 Rand had you not bought the printers. So 10% of the 200,000 plus the 10,000 each year, it gives you some idea of the user cost of capital per year, or the annual cost of owning that equipment had you purchased it as opposed to just renting it. We can also express the user cost of capital as a rate per dollar of capital. So that R represents the rate per dollar of capital, and that is given by the depreciation rate plus the interest rate. So let's say the printers depreciate by 5% each year, and the interest that you could have earned was 10%, then the rate per dollar of capital is 15% per year. So bearing this in mind, how would you then choose a combination of, say, labor and capital, ultimately to produce some given output, but you want to minimize your cost of production, and you need to factor in both the wages of the labor and the user cost of capital for that capital input. Now, this is a fundamental problem that a firm faces. How to select inputs to produce a given output, but at a minimum cost. So for simplicity, for the rest of the chapter, we are going to work with our two variable inputs, and it's going to be labor and capital, respectively. And labor is going to be measured in hours of work per year, and capital is going to be measured in hours of use of machinery per year. Now, capital equipment, like I said, typically needs large cash outlays in the beginning, and it is going to be useful to draw a comparison of the yearly cost of labor with the capital expenses in the same way. So the capital expenditure must thus be spread over the years that you have the capital. And from the previous slide's discussion, we saw that the price of capital was the user cost of having it, and it is determined by R equal to the depreciation plus the interest foregone, right? Now, in these instances, the focus was on purchasing the capital equipment. For instance, if you bought all the printing machines you needed for our hypothetical print shop. But what if you rented it instead of purchasing it? Then we say the price of capital is the cost each year of renting a unit of capital, and that is referred to as the rental rate. The rental rate is the cost per year of renting one unit of capital. Now, if the capital market is competitive, then the rental rate should be equal to the user cost R. And the question we ask ourselves is why? So, a firm that owns capital will expect to earn some competitive return if they were to rent it. So this competitive return is the user cost of capital. So the capital that is purchased can be treated as though if it were rented at a rental rate equal to the user cost of capital. So we are going to assume for our analysis that the firms rent all its capital at the price R, which is the rental rate, and firms also use labor at a wage rate W. So when labor and capital is used or hired, there is a cost attached to it. Now, an isocost line is a graph that is going to show us all the possible combinations of labor and capital that can be bought for a given total cost. The equation 7.2 tells us what an isocost line would look like. C gives you the total cost of producing some output, and it is given by WL, the wage rate, times L, how many units of labor, and that represents the labor cost, plus RK, R is the rental rate, which we just spoke about, times how many units of capital that is being employed, and that gives you the capital cost. So your labor cost plus your capital cost would yield your total cost of producing any particular output. So if we were to rewrite this total cost equation 7.2 as a straight line, so we have capital plotted on our vertical axis from our convention in chapter 6. So if capital is plotted on our vertical axis, then K would be the subject of the formula if it is written as an equation for the straight line. And rearranging, we get our vertical intercept, and that would be C over R minus W over RL. So W over R, which is the ratio of your wage rate to your rental rate, this represents the slope of the straight line, the slope of your isocost line. And you can see that it is negative. So this tells me that this straight line and this isocost line must be downward sloping. So it follows that your slope, as you would have your slope for any straight line function, it is your change in your vertical axis over your change in your horizontal axis. So the change in your capital over your change in labor is equal to the negative ratio of your input prices, W being the price of labor and R being the price of capital. So you can see that your ratio of your wage rate to your rental cost of capital gives you the slope of your isocost line. Now, how do we go about producing a particular output while keeping our costs as low as possible? This is something that the firm must consider. So we have figure 7.3, and it discusses producing a given output at a minimum cost. The explanation for this will take quite some time, and for the current 15-minute video, I won't have sufficient time, so I'm going to pause it and then start the new video on this particular slide.